One of the main goals with investing is to at least match, if not beat, the S&P 500 every year, and eventually turn something as little as a few $100s into a multi-million-dollar portfolio over the long term. So I recently found a 3-fund portfolio that absolutely destroys the S&P 500 every year, with a 15.8% annual return since the year 2010. Now, something I really like about this 3-fund portfolio is that each ETF is issued and managed by the same firm, and they're not Vanguard or Schwab ETFs. They're actually owned by State Street, so they're SPDR funds, or some people call them spider funds. And each ETF tracks a specific sector, which allows a lot more diversification to this portfolio compared to others. So we're going to talk about each ETF individually, then towards the end, we're going to compare this 3-fund portfolio to the S&P 500 and see how it's performed in relation to that benchmark. So the first one is XLK, or the Technology Sector ETF, currently priced at $215.19, right at the top of its 52-week range. Now this ETF, because of how much exposure it has to the tech sector, tends to grow extremely fast when we're in a bull market. So this year alone, it's up 15% with a 1-year return of 41%. Now these SPDR funds are also very low cost, so XLK has an expense ratio of 0.09% with a dividend yield of less than 1%. So out of the 3 funds, it pays the lowest amount in dividends, but it does make up for it with all that growth. And when it comes to its holdings, there is a lot of exposure to both Microsoft and Apple. Together they make up over 40% of the fund. And some might argue that it's a little overexposed to both Apple and Microsoft, but these 2 stocks have contributed to all that rapid growth over the years. It also holds a lot of other fast-growing technology companies like Nvidia, Broadcom, Salesforce, and AMD. So with that in mind, XLK is going to make up about 55% of the portfolio, which brings me to the next one, which is XLV, or the Healthcare Sector Spider ETF. So this fund invests in most, if not all, of the largest and most successful healthcare companies in the United States. It has 65 total holdings, with its top 3 being Eli Lilly, United Health Group, and Johnson & Johnson. It also charges that really low expense ratio of 0.09%, and pays a pretty decent dividend yield of 1.5%. Something I really like about XLV is that because it's a healthcare fund, it's not as volatile as other ETFs. For example, in 2022, when other stocks fell 20 to 30%, XLV sort of held its ground and only dropped no more than about 10%. So XLV is definitely an ETF that offers health and safety to any portfolio. And yes, that pun was definitely intentional. So in the 3-fund portfolio, XLV is going to be at 30%, leaving the last 15% for XLE, or the Energy Sector Spider ETF. So XLE is mostly comprised of oil and gas companies, and as we know, since about late 2020, the energy sector has been producing really incredible gains, with a 250% return, including dividends, since that time. And something I really like about XLE is its dividend yield is at 3.2%, so paying just under $3 per share every year, which also, of course, increases that dividend yield for this 3-fund portfolio. Now, XLE only has 25 holdings, with ExxonMobil there at the top, taking most of the weighting at 26%, with other familiar names like Chevron, ConocoPhillips, and Phillips 66 in the top 10. So now let's compare this 3-fund portfolio to the S&P 500 returns over a period of about 15 years. So starting with $10,000 back in 2010 and only reinvesting the dividends, not contributing any other capital, we'll plug in the 3-fund portfolio with 55% in XLK, 30% in XLV, and 15% in XLE. We'll see how it performed against SPY. So at the end of this 15-year time frame, our 3-fund portfolio, we'll call it the Spider Fund, completely outpaced the S&P 500. That $10,000 is now worth nearly $82,000, whereas $10,000 in SPY is only worth about $59,000. Now, another thing I really like about this specific 3-fund portfolio is the fact that within that 15-year period, there weren't any years where all 3 funds had a negative return, which really shows the power of diversification. So in my opinion, I really think these ETFs are very underappreciated and kind of underrated as well. So I want you to let me know what you think of these 3 ETFs, as well as your thoughts on this 3-fund portfolio, and I'll see you next time.